From 1st of January 2026, every crypto platform serving UK users will have to hand HM Revenue and Customs the names and wallet details of buyers and sellers. Proof that British regulators are turning the spotlight from Wild West to full financial transparency. I'm Dr. Eleftheria Panagiotopoulou, and this is the By the Rules, a fact-driven podcast that unpacks the regulation, policy debates, and compliance challenges shaping emerging technologies. Each episode draws on detailed research based on official sources, consultation papers, and reports published by national regulators, central banks, and international organizations such as the Financial Action Task Force for International Settlements, the International Organization of Securities Commissions, and the International Monetary Fund. This podcast does not promote investment or endorse any technology. Its sole purpose is to explain how the rules work, expose unresolved gaps, and direct you to authoritative guidance. For specific legal or compliance obligations, always consult the relevant supervisory authority and professional advisors. And now, let us begin. Today, we dive into the United Kingdom, a country with a distinct geopolitical identity, deep-rooted into financial influence, and a unique approach to regulated the fast-evolving world of crypto assets. Why it matters now? The UK still holds significant influence in global affairs, with a permanent seat on the United Nations Security Council, a leading role in the Group of 7 economies, and strong capital markets centered in London. Since leaving the European Union, the UK has aimed to align trade, investment, and security under what is often called securonomics. This approach is taking shape as the country's digital economy rapidly expands. The Electronic Trade Documents Act of 2023 gave electronic records the same legal status as paper documents, and the local financial technology firms working in areas like artificial intelligence, payments, and blockchain. So now making up a growing part of the UK service exports. These developments position the UK as a key testing ground for digital asset regulation. It is neither a tax haven nor a country that bans crypto, but instead seeks to become a regulatory model in progress, balancing innovation with consumer and market protection. The year 2025 has marked several milestones. In April, the Treasury released a draft Crypto Asset Order 2025, the first law aimed at bridging exchanges, custodians, and lenders fully under the Financial Services and Markets Act. In May, the Financial Conduct Authority opened consultations on stablecoins and the protection of client crypto assets, setting out proposed rules on asset backing, redemption, and the separation of customer funds. On June 6th, the authority announced plans to lift the retail ban on crypto exchange traded notes, reopening a route to mainstream investment that had been closed since 2020. Later that month, IG Group, in partnership with Uphold, became the first London-listed broker to offer direct trading in over 30 digital tokens, making a shift towards a regulated crypto access. So, is the UK building a clear regulatory framework or simply responding to market and political pressure? In reality, it is moving from fragmented oversight to a more complete regulatory model, covering stablecoins, custody, trading, taxes, and investment products. This is not a free-for-all. It is a cautious, step-by-step strategy designed to support innovation while safeguarding trust. Before we step into the historical timeline, let us set the baseline. Two things that really matter What kinds of tokens the regulator recognizes and why people adopt them in the first place? According to the HMRC, crypto assets, also referred to as tokens or cryptocurrency, are cryptographically secured digital representations of value or contractual rights that can be transferred, stored, and traded electronically. Every digital token in the UK sits in one of the following buckets. Exchange tokens. So exchange tokens are intended to be used as a means of payment and are also becoming increasingly popular as an investment. This is due to potential increases in value. The most well-known token, Bitcoin, is an exchange of an exchange token. Then we have the utility tokens. So utility tokens provide the holder with access to particular goods or services on a platform, usually using the DLT. A business or group of businesses will normally issue the tokens and commit to accepting the tokens as payment for the particular goods or services in question. In addition, utility tokens may be traded or exchanges or in peer-to-peer transactions in the same way as exchange tokens. And then we have security tokens, which provide the holder of security token particular rights or interests in a business, such as ownership, repayment of a specific sum of money, or entitlement to a share in future profits. And then we have the stablecoins. Stablecoins are another prominent type of crypto asset. So the premise is that these tokens minimize volatility as they may be pegged to something that is considered to have a stable value, such as fiat currency, like government-backed, for example, the US dollars, or precious metals, such as gold. Other countries draw different lines. So if you are following along from abroad, always check your own rulebook. A review of over 30 global studies highlights 4 key dimensions influence cryptocurrency adoption, including legal, economic, socio-cultural, and technological. When we look at it from legal perspective, adoption tends to accelerate in countries with clear regulatory frameworks, political stability, and proactive digital strategies. From an economic point of view, income levels, market volatility, low-cost transfers, and financial inclusion all play a role. Socioculturally speaking, public trust, financial literacy, and openness to new technologies significantly shape adoption rates. And then, technologically speaking, widespread internet access, secure infrastructure, and scalable digital systems are essential enablers. But where does the UK stand? Legally speaking, the UK requires firms to register with the Financial Conduct Authority for anti-money laundering purposes. However, it still lacks a comprehensive licensing regime for spot exchanges and decentralized finance platforms. Post-Brexit, flexibility has also introduced regulatory uncertainty. Now, economically speaking, the UK is a mature, high-income country, but crypto firms face limited backing access and retail investors lack crypto-specific tax incentives, factors that constrain broader engagement. Socioculturally speaking, surveys suggest that many retail users view tokens as speculative. Recent advertising restrictions by the regulator reflect ongoing concerns over consumer protection. Technologically, the UK performs strongly, with a nationwide broadband, a world-class fintech section, and a digital security sandbox, and the Bank of England's digital pound pilot, which makes the country well-positioned in terms of infrastructure. So, the UK shows strong technological readiness, but still faces legal ambiguity and, hesitant adoption, making it promising, yet cautious environment for crypto growth. Now, let us look into the tone and language of official UK government and regulator communicators based on what they have published and why that wording really matters. In 2018-2019, statements are dominated by terms such as ban, high risk, and consumer detriment, setting a firmly restrictive stance. The language turns even more defensive in 2020-2021, when the retail crypto derivatives ban is announced. Restrictive phrasing picks across all our visuals. From 2022 onward, however, official releases begin pairing risk words with opportunity words. Responsible innovation, proportionate guardrails, and average sentiment turns positive after 2023, as initiatives like GFOX and the Digital Securities Sandbox are published. By 2025, the vocabulary is even split. Innovation-friendly terms appear as often as risk-based ones. So signaling a calibrated shift from blanket caution to a promote but protect philosophy language that both reassures the market and keeps consumer protection front and center. What does this shift in tone suggest about the UK's evolving regulatory strategy and the role of language in balancing innovation with public trust? The shift in language reflects a deliberate move from defensive regulation to strategic positioning, signaling that the UK aims to foster innovation while maintaining credibility and consumer protection. This evolving tone functions as a governance tool, managing both market expectations and political accountability. Definitions, drivers, and tone and language in place. So, let us rewind the clock and see how the UK journey began, or in other words, how we got here. So basically, between 2014 and 2017, it was all about curiosity and caution. London startups experimented with cross-border Bitcoin remittances, and a handful of initial coin offerings raised funds from British investors. Digital tokens sat outside mainstream financial services law, and the Bank of England limited its role to monitoring risks and opportunities. Then, looking into 2018, it was all about policy awakening. In March 2018, the Treasury, the Financial Conduct Authority, and the Bank of England created the Crypto Asset Task Force. Its October report called for proprietary regulation, anti-money laundering supervision, and clearer tax guidance, turning crypto from a curiosity into formal policy issue. That same year, His Majesty's Revenue and Customs published its first detailed guidance on the tax treatment of digital asset gains. And then looking at it from 2019 to 2021, we went from gaps to guardrails. So in July 2019, the Financial Conduct Authority proposed banning the sale of cryptocurrency derivatives and exchange-traded notes to retail investors, citing extreme volatility. In January 2020, amended money laundering regulation came into force, requiring exchanges and wallet custodians to register with the Financial Conduct Authority before serving UK users. In early 2021, the Treasury launched a wide consultation on bringing stablecoins and other crypto asset activities fully inside the financial services perimeter. And then let's look at it from 2020 to 2023. So these 2 years, 2020 and 2023, were all about consolidation and tightening. In March 2022, the Advertising Standard Authority issued an enforcement notice to more than 50 crypto businesses after a series of misleading adverts. In June 2023, the Financial Services and Market Act received royal assent, giving ministers broad powers to set detailed rules for trading venues, custody, stablecoins, and market abuse. In July 2023, the Electronic Trade Documents Act granted electronic trade records the same legal status as paper. In October 2023, the new marketing rules for crypto assets took effect. Prominent risk warnings, cooling off period, and a ban of refer a friend incentives. And then from 2024 to 2025, we have a full spectrum design. So basically, during 2024, the Treasury began drafting secondary legislation under the new act. And then on 29th of April 2025, the Treasury published the draft crypto asset order. On the 3rd of June 2025, the FCA released consultation paper 2514 on fiat-backed stablecoin issuance and custody safeguards, followed on 6th of June 2025 on consultation paper 2516, which proposes lifting the retail ban on crypto exchange trading notes backed by Bitcoin or Ether. And then looking a little bit ahead, perhaps 2026, it's all about tax spotlight. From 1st of January 2026, rules aligned with the International Crypto Asset Reporting Framework will require every platform serving UK residents to collect and report user and wallet data to His Majesty's Revenue and Customs, extending compliance from anti-money laundering into full tax transparency. So how did the UK's approach to crypto evolve from curiosity to full regulation? And what does that tell us? The UK moved step by step from cautious observation to building a full regulatory framework. Starting with monitoring and basic guidance, it gradually introduced rules on anti-money laundering, consumer protection, and market integrity. This shows a deliberate phase strategy that supports innovation while steadily closing legal and supervisory gaps. Our next topic, which is how the rulebook looks like today. So, now that we know how the UK has reached this point, let us talk through the rules that apply right now. Think of them as 5 legal pillars with 6 experimental lanes for cutting-edge projects. I will move pillar by pillar so you can hear what is already in force and what still is proposal and where these gaps remain. So the pillar 1 is registration and anti-money laundering supervision. Since the 10th of January 2020, every business that exchanges, holds or transfers digital tokens for people in the UK must register under the money laundering regulations. With the Financial Conduct Authority, regulation is no rubber stamp. So fewer than 1 in 5 applications have passed. So the regulator checks senior management integrity, blockchain analysis tools, and whether the firm can track the origin and destination of funds. So this is the so-called travel rule, which applies to every transfer, no matter how small. However, a regulatory blind spot remains. Fully decentralized activities, services where no identifiable operator exists cannot currently be compelled to register, as there is no legal entity to hold accountable. That said, front-end providers or interfaces that facilitate user access to such decentralized protocols may still fall within the regulatory perimeter if they effectively act as intermediaries or service providers to UK users. Now let's look into Pillar 2, which is about consumer protection and promotions. So on October 8, 2023, the Financial Conduct Authority introduced new rules requiring that any crypto advertisement aimed at UK consumers must be approved by an FCA authorized firm or issued by a fully authorized business. Each ad must feature a clear risk warning, such as be prepared to lose all the money you invest. And first-time consumers must wait 24 hours, a cooling-off period, before placing their first order. Incentives like bonuses or refer a friend schemes are banned. Within the first 18 months, over 1,500 online promotions were withdrawn or modified in line with the regulations. Let us now look into the Pillar 3. This is related to trading, venues, custody, and market integrity. Retail investors are still banned from buying options, futures, and contracts for difference that reference digital tokens. The ban has been in place since January 2021. The Financial Conduct Authority is now consulting on reopening a very narrow channel, exchange trading notes backed by Bitcoin or Ether, provided investors pass an appropriateness test. Custody is moving next. Draft rules published in May 2025 would make providers segregate client tokens from house assets, reconcile holdings every day, and carry insurance against hacking or fraud. After that, market abuse legislation will follow, turning insider dealing and price manipulation in digital tokens into civil and criminal offences once those tokens are admitted to trading or UK venues. Spot trading exchanges will rely only on their money laundering registration, but venue-specific licenses covering order book transparency and conflict of interest controls are on the Treasury's agenda. Let us now look into the fourth pillar, which is related with the it's related to tax treatment. Capital gains, old digital tokens, are taxed at 18% for basic rate taxpayers and 24% for higher rate and additional rate taxpayers. The annual exempt amount falls to £3,000 in April 2025. Mining rewards, staking yield, and airdrops received for effort count as miscellaneous income and follow the ordinary income tax bands, which top out at 45%. Exchanging one token for pounds is treated as a financial service and is therefore exempt from value-added tax, but ordinary value-added tax rules apply if you pay for goods with a token. From the 1st of January 2026, the bartering titans, again, every platform serving UK residents must report client identities, wallet addresses, acquisition cost, and sale proceeds to His Majesty's Revenue and Customs under rules aligned with the International Crypto Asset, the reporting framework. Now, let us look into the fifth pillar, which is related to stablecoins and payments. So tokens that claim one-for-one backed with fiat currency, pound sterling or otherwise, will be treated as digital money. Issuers must hold backing assets in a statutory trust at the regulated institution, publish daily reserve statements, and guarantee redemption at face value on the same day a request is made. If a stablecoin grows large enough, roughly £10 billion of outstanding tokens is the informal maker. The Bank of England can declare it systemic and impose liquidity and capital buffers. Wallet providers that offer stablecoin payment accounts will need a license similar to that of an electronic money institution, which carries its own safeguarding and wind-down obligations. Algorithmic stablecoin and commodity-backed tokens remain outside the payment parameter for now, although consumer protection or securities rules can still bite if they are marked to the public. Now, for firms building at the frontier, the UK offers three test beds. The regulatory sandbox, running since 2016, has admitted 9 cohorts and more than 20 crypto projects that later graduated to full registration. The Digital Security Sandbox, launched in 2023, lets companies issue and settle tokenized shares and bonds on distributed ledgers under modified settlement rules. A financial market infrastructure sandbox is due in 2026 for trading venues and clearing houses that want to trial instant ledger-based settlement at industrial scale. Alongside these formal sandboxes, the Financial Conduct Authority hosts yearly 10 sprints that produce open source prototypes for analytics, regulatory reporting, and stablecoin resilience. Well, now put all 5 pillars together and the message is very clear. Registration is hard to obtain, marketing is tightly policed, high-risk derivatives are still off limits for ordinary investors, tax reporting will become automatic in 2026, and pound-backed stablecoins will soon live under a full electronic money rule set. What the country does not yet regulate, algorithmic stablecoins, fully decentralized finance pools, and self-running contain markets, sits securely on the regulator's to-do list for the next legislative cycle. Although we have mentioned regulators throughout, we have not yet paused to clarify who they are or what they exactly do. So, before we turn to real-world cases, let us take a moment to meet the key UK agencies responsible for overseeing the crypto space. His Majesty Treasury sets policy, drafts the legislation, and decides which digital asset activities sit inside financial services law. Then the Financial Conduct Authority licenses firms, supervises the anti-money laundering controls, and approves or blocks every crypto advertisement aimed at UK consumers. Then the Bank of England safeguards financial stability. Through its Prudential Regulation Authority, it oversees banks that offer custody or settlement services, and it will take charge if a pound-paid stablecoin grows large enough to be deemed systemic. Its Financial Policy Committee can issue economy-wide risk warnings. The Payment System Regulator, this is an independent arm of the Financial Conduct Authority, which promotes competition and resilience in payment rails and will share oversight of stablecoin payment systems. The Advertising Standards Authority is the gatekeeper for all marketing claims, pulling any advert that is misleading, irresponsible, or missing the mandatory risk warning. His Majesty's Revenue and Customs taxes capital gains and mining income, and from 2026 will receive wallets, as we said earlier, and transaction data directly from exchanges under the new reporting rules. Now, for serious crime, the National Crime Agency, the National Economic Crime Centre, and specialist cyber units within the City of London Police trace and seize illicit digital assets and bring criminal charges. Together, these bodies form a layer regulatory safety net. The Treasury sets the rules, conduct and prudential regulators enforce them. The advertising watchdog keeps messaging in check. The tax authority follows the money, and criminal agencies intervene when the law is broken. With the cast now assembled, let us explore how these powers are applied in practice. Moving on, rules are only half the story. People and places turn rules into reality. So let us take a quick tour of the UK crypto asset ecosystem so we know who is actually building, lobbying, and researching inside those 5 legal pillars. So, first up, civil society. Trade Association Crypto UK has fired off more of 100 consultation responses since 2020. And now runs the industry's hotline on the new advertising regime. On the consumer side, Money and Mental Health Policy Institute push for plainer risk warnings, while Open Rights Group keeps a close eye on privacy in travel data transfers. Next, the academic engine room. UK universities support the sector by offering courses on blockchain, crypto assets, and digital finance. UCL, Cambridge, Oxford, and Imperial are among those providing academic input and skills training relevant to policy and regulation. Now, homegrown tokens worthy of mention include Electronium, which launched in 2017 and claims over 4 million users and is active with Digital Pound Foundation's working groups. Stablecoin, a community interest company, emphasizes social impact payments through partnerships with local charities. Now, rules count only when someone enforces them. So in the UK, 3 lines of defense now do the heavy lifting. Licensing and supervision by the Financial Conduct Authority, then the advertising and oversight by the Advertising Standards Authority working hard in glove with the promotions gateway, and then criminal or tax action by specialist police units and His Majesty Revenue and Customs. Now let us take each line in turn with dates and numbers that show how firmly the net is tightening. So registration became mandatory on 10th of January 2020. Since then, 263 crypto businesses have applied. Only 47 are still on the register. That means roughly 85% of applicants fail at their first hurdle. The common flaws are predictable. No blockchain monitoring software, directions unable to prove the source of client funds, and books that mingle customer money with house money. When the authority finds a breach, it moves fast. On the 25th of June 2021, it issued a restriction notice to Binance Market Limited, barring the firm from all regulated activity in the UK until governance and reporting standards improve. And when unregistered crypto cash machines kept spitting out pound notes in corner shops, the regulator went to court. A high court order in May 2023 shut down more than 30 such machines in order sweep. Then the second line is advertising. The Advertising Standards Authority began shuttling in late 2020, and by March 2022, it had issued an enforcement notice to 51 firms, from football clubs to fintech apps, giving them 30 days to clean up their messaging. The legal gateway raised the bar even higher on the 8th of October 2023. Every crypto advert now needs a formal approval, as we said earlier. Since then, the Financial Conduct Authority has flagged more than 200 unauthorized crypto promotions and persuaded website hosts to remove 169 pages within 48 hours. The mandatory script, you could lose all the money you invest, again, must be spoken or shown, and first-time buyers face a 20-hour cool-off period, bonuses, cashbacks, and referral friend deals, all this gone. Well, beyond licenses and adverts, the Financial Conduct Authority also uses what insiders call the Dear Chief Executive letter. One went out on the 10th of March 2022 to every registered custodian. Hold client tokens and trusts, reconcile them daily, and ensure them against hacks. Follow-up visits later that year found 6 firms still co-mingling assets. Each was given 90 days to fix the problem or face a revocation. In January 2024, the authority froze 2 over-the-counter brokers after discovering they had processed £65 million linked to ransomware payments without filing a single suspicious activity report, SAR. Now, which statutes actually bite? Well, break the rules and the penalties bite. Criminal charges can range from money laundering under the Proceeds of Crime Act 2002 to fraud under the Fraud Act 2006, and even sanctions breaches under the Sanctions and Anti-Money Laundering Act 2018. On the civil side, you could face a negligence or breach of contract claims or pay damages for an unauthorized promotion under the Financial Services and Markets Act 2000. Well, bottom line, crypto misconduct in the UK can land you in court and in jail. Law enforcement units now treat blockchain tracing as routine. The Metropolitan Police seized £180 million in digital asset on the 13th of July 2021, Britain's largest single crypto take to date. His Majesty's Revenue and Customs broke new ground on Valentine's Day 2022. When it confiscated 3 non-fungible tokens during a value-added tax fraud probe. The tax office has since opened more than 450 compliance cases on undeclared crypto gains, a figure up by 1/5 year-on-year. And from the 1st of January 2026, exchanges and wallet providers must send wallet identity and transaction data directly to, as we said earlier, the tax authority under the new international reporting framework. Fraud numbers tell their own story. The National Fraud Intelligence Bureau logged more than 12,000 crypto fraud reports in 2024, totally almost £300 million in losses. Nearly half came from the so-called pickpocketering romance investment con, including a single UK victim who lost £162,000 to a fake trading platform that mimicked live market data. At the 8,000 British customers saddened by the 2022 collapse of FTX, £500 million frozen, and the human cost of weak due diligence becomes painfully clear. But what happens when an overseas crypto platform implodes and British users are left holding the bag? Well, 3 collapses tell the tale. Celsius Network held withdrawals on the 13th of June 2022. Roughly 12,000 UK accounts holders saw £54 million frozen overnight. Voyager Digital entered Chapter 11 4 weeks later. Its British customer base, about 8,000 users, had another £11 million stuck in limbo. Then came FTX, the headline giant. When the exchange failed in November 2022, an estimated 80,000 UK customers lost access to more than £500 million worth of tokens and cash balances. None of these firms held a UK license, only a web login. Yet the fallout was local and immediate. The lesson is stark. Even the best domestic rulebook cannot shield consumers from failures that start offshore. So far, the UK has tightened enforcement onshore, but enforcement alone cannot fix what still lies beyond the perimeter. Even with tighter enforcement and detailed rulebook, the UK still faces 3 unresolved policy challenges, each bigger than any single regulator. The first is how to balance innovation with financial stability. The second is how to regulate what currently sits outside the legal perimeter. And the third is how to stay aligned with evolving international standards while remaining competitive. So, His Majesty's Treasury promotes regulate to innovate approach, aiming to keep London competitive as a hub for fintech and blockchain development. The Bank of England, by contrast, places greater weight on financial stability and has made clear that any pound-backed stablecoin large enough to impact the payment system would fail under its prudential supervision. The Financial Conduct Authority sits between these 2 positions, tasked with protecting consumers while also under pressure to preserve market competitiveness. So several activities still fall outside direct supervision. Automated markets, so markets lending protocols and staking pools often have no identifiable operator, leaving the regulator with no entity to license or fine. Only fiat-backed tokens are covered by forthcoming payment rules. Algorithmic or metal-backed designs remain unclassified unless other laws, such as securities or consumer protection rules, are triggered. Most NFTs are treated as digital collectibles rather than regulated investments. Only fractionalized or revenue-shared versions may be caught by securities law. Node operators and validators provide critical services, yet running blockchain infrastructure is not currently a licensable activity. These gaps mean that a retail investor buried from a leveraged Bitcoin product could still lose money in an unlicensed decentralized lending pool, or hold an algorithmic coin that offers no redemption right. So UK officials maintain that the new regime aligns closely with international standards. It incorporates anti-money laundering guidance from its Financial Action Task Force, FATF, while also tracking ongoing work by the International Monetary Fund and the Bank for International Settlements on Stablecoin risks and financial stability. Regulators are also monitoring the European Union's market in crypto asset regulation to ensure investor protection principles remain broadly compatible. Industry groups welcome the UK's flexible phased approach. However, consumer advocates quote that too much divergence could complicate compliance and increase enforcement costs, especially for cross-border services. So together, these unsolved challenges point to a simple truth. The rulebook may be growing, but the questions shaping the next chapter of UK crypto regulation go beyond technical compliance. How to govern code without killing innovation, how to protect users in markets without intermediaries, and how to stay competitive while keeping step with global standards. These are not just regulatory puzzles, they are strategic choices that will define the UK's role in the digital asset future. So let us fast forward. Here are the milestones UK crypto firms need to circle on the calendar between now and early 2027. So the Draft Financial Services and Market Act, Crypto Assets Order 2025, is now in the Parliament. If lawmakers approve it this autumn, the Financial Conduct Authority will gain full rule-making power over spot exchanges, lending platforms, custody, and market abuse. A 6-month grace period is planned, so the complete rulebook could go live by mid-2026. Consultations on pound-backed stablecoins and on token custody closed in June. Final policy statements are scheduled for the first quarter of 2026. Key points includes issuers must hold reserves in a statutory trust and offer same-day redemption and face value. Custodians must segregate client tokens, reconcile daily, and carry insurance. So from New Year's Day 2026, every exchange and wallet provided serving UK users must transmit customer identities, wallet addresses, accreditation costs, and sale proceeds to His Majesty Revenue and Custom under the new crypto asset reporting framework. A pilot data portal opens in November, giving firms 8 weeks to integrate. Treasury and the Bank of England will publish an update on the digital pound by the end of 2025. If a pilot goes ahead, testing could begin in 2026. That same year, the Financial Market Infrastructure Sandbox will open for a ledger-based settlement at clearinghouse scale, and the Digital Security Sandbox will admit a second cohort of tokenized bond issuers. Cycle these days. So New Year's Day 2026 for tax reporting, Spring 2026 for final stablecoin and custody rules, and mid-2026 for a fully empowered Financial Conduct Authority rulebook. The clear message: build your compliance architecture now, because the countdown has begun. With the current landscape mapped, it is time to look ahead. The next 2 years will be pivotal, and draft laws move towards implementation and key compliance deadlines come into focus. Now, here is what is on the horizon for crypto firms operating in the UK. Since April 2021, HM Treasury and the Bank of England have jointly led a central bank digital currency task force to coordinate exploration of UK CBDC. The initiative supports a structured evaluation of design, use cases and risks, while also monitoring international developments and engaging diverse stakeholders through dedicated engagement and technology forums. Launched by the Bank of England, the Digital Pound Lab is a simulated testing environment, not a regulatory sandbox, designed to let industry participants experiment with retail CBDC use cases and business models. Running from August 2025 to July 2026, it enables testing through predefined and innovation scenarios without involving real users or actual money. The Digital Security Sandbox officially opened on 30 September 2024, offering firms a controlled environment to test tokenized issuance, trading and settlement of GITs and corporate bonds with statutory finality. Backed by a 4-year operation window through late 2028, it gives successful projects room to scale before a permanent regulatory regime is established. The FCA's regulatory sandbox allows eligible financial firms to test innovative products and services with real customers in a controlled environment under close regulatory supervision. Active since 2016, it is open year-round to firms that meet the FCA's criteria and aims to support innovation that benefits consumers without lowering regulatory standards. The Investment Association's 2023 blueprint sets out a phased approach for bringing authorized retail funds into distributed ledger technology, starting with daily share class minting and real-time NAV reporting. Supported by the Financial Conduct Authority, the plan aims to modernize fund infrastructure while preserving investor protections. So together, these initiatives signal a clear direction. The UK is not just regulating crypto, it is actively building the infrastructure to support reasonable innovation. For firms, the message is clear: adapt early, engage with test beds, and prepare for a rule set that rewards readiness. Let's conclude with the emerging priorities that matter across the regulatory, industry, and consumer landscape. While this overview is intended for educational and informational purposes only, it reflects the practical implications of the UK's evolving crypto framework and highlights areas where proactive engagement could prove beneficial. So in terms of regulatory priorities, clarity, they will have to clarify the DeFi perimeter by the third quarter of 2026, enabling innovation to understand when an automated lending or liquidity pool constitutes a regulated activity. Establish a full market abuse rule set within 12 months of the crypto asset order becoming law, aligning token venue oversight with existing equity market safeguards. Then we have the launch a public register of approved crypto promotions, offering a transparent reference for platforms and consumers to verify advertisement legitimacy industry. So now looking into the industry considerations, we can embed in wallet, reconciliation, asset segregation, and on-chain monitoring as standard operational practices, given their likely centrality to future anti-money laundering and custody requirements. Engage with early with HMRC's crypto reporting portal during the November pilot phase to ensure smooth integration and avoid last-minute compliance pressures. Participate in or help from incident response groups aimed at sharing blockchain threat intelligence in a way that mirrors cooperative models used by traditional financial institutions. And then in terms of consumers, we need awareness. So check the FCA register before engaging with an crypto firm. The presence or absence of registration remains a key indicator of oversight. Approach algorithmic, stablecoins, and unregulated DeFi protocols with caution, and recognizing that they currently fall outside the protective scope of most regulatory safeguards. Support or seek out independent crypto education campaign, particularly those that they raise awareness around volatility, tax obligation, custody risks, and anti-money laundering expectations. So the UK has led to groundwork, registration, custody, tax rules, and stablecoin oversight are taking shape. But the front remains open. DeFi, algorithmic tokens, and market abuse still sit in regulatory gray zone. The challenge now is to close those gaps without closing the door on innovation. Trust in crypto will depend not just on code, but on credible, evolving rules, and the UK's regulatory story is still being written. Thanks for tuning in. Until next time, stay informed, stay critical, and stay ahead of crypto and the emerging technologies reshaping our world.